Welcome to Market Masters. Even as Indian equity indices are trying to find their feet, Indian bonds have been having the makings of a rally. Inflation, that is CPI inflation, has been coming below expectation for 2 months in a row, Jan and Feb. In fact, February CPI was below the MPC target of 4%. It came in at 3.61. US inflation too came in below expectations for February. The numbers came last week. And then the Reserve Bank has been taking consistent and seminal steps to boost liquidity. How are fixed income markets placed from here on? And more importantly, what may be the impact of this falling cost of capital on banks, NBFCs and corporates in general? For all these questions, I have with me the CIO of Axis Mutual Fund, Ashish Gupta. Ashish is also one of the best experts we have on financial companies in the country, on F&O volumes, all things market. So, Ashish, thank you very much for sparing time for us this morning. Well, for starters, what's your sense about the Reserve Bank rate cut itself? Now people are running away with expectations of even a stance change and maybe double cuts in April. Your take?
So I think given how inflation has softened, and particularly food inflation, which had been a sticky concern for multiple months, I think consensus is quite clearly betting on a rate cut in April, and in fact, potentially 2 rate cuts coming in during the course of the year. So I think that is certainly on the cards. But I think what is most encouraging is the fact that the central bank has been very decisive in terms of really addressing the liquidity situation. And I think you also in your show have highlighted over the past few months how challenging both the core liquidity and the banking liquidity was. And I think these steps that central bank has taken over the past couple of months have decisively addressed it. So if I aggregate all their actions on liquidity in terms of VRR, in terms of OMO purchases, in terms of forex swaps, there has been nearly 6 trillion rupees, or actually a little more than that, that's been really provided as support. Okay. So I think that is, for me, the most important really action by the central bank. Rate cuts and the stance change, of course, has come in more recently, particularly post the inflation print.
Okay, so would you therefore say that we are anywhere close to passing on the deposit cuts, considering that the liquidity is seminal? When do you expect the first deposit rate cut from banks?
So I think not before May or June. I think banks are kind of still struggling to kind of raise deposits. Banking liquidity, as you know, has not turned positive. It's expected to turn positive by April, May only, while the core liquidity has turned positive after this step. The banking liquidity deficit, which was more than 3 trillion rupees, has moderated. It's now less than 2 trillion rupees, but it is still not gone in surplus. Most banks, as you know, have a fairly high loan deposit ratio, particularly viewed from the central bank's lens. And they have actually had to pull back some bit on credit growth. So I think banks are still trying their best to step up deposit growth. And I don't think in the coming weeks, deposit rate cuts are expected. I think deposit rate cuts will be preceded by banking liquidity turning into surplus.
Okay. So immediately, banks for the next 2 quarters are in danger of margins getting reduced. Would you say the rate cut beneficiary is more NBFCs then?
Yes. So I think certainly rate cut beneficiaries will be NBFCs. As you know, the repo rates repo rate cuts typically negatively impact bank margins now because large part between 40-45% of their loan book is indexed to the repo rate. So in fact, we will see the January rate cut itself leading to from 1st April step down in loan yields for banks, particularly on mortgage loans. So that will impact them. But I think more important is what happens on their credit growth. So even if the margins comes down, but if banks are able to step up credit growth, because of better deposits and because of better liquidity, I think that's positive for banks.
Okay. What's your sense about the FII flows itself? Bond has been positive, right, through March and Feb.
Yes.
And the equity flows, the negativity is thinning. Would you take a bet that we are bottoming out in terms of FII outflows?
So I think we see really a couple of indicators as really providing some lead signals to flows. One of them is really how the global bond yields are trending, and secondly, what's happening to the dollar index, right? And if you recall, the dollar index had moved up really after the Trump presidency to nearly 110, and over the past couple of months, it's pulled back to around 103, and actually, it's now back down to the level that was there in October. Yes. So I think that is a really positive signal in terms of the direction of FI flows. If I look at US 10-year yields, which in September was around 3.8, they had shot up to nearly 4.75. They have since then pulled back by about 45-50 basis points. And that's also trending positively. But here, I think we don't have really a very strong signal that they will continue to soften. Okay. So I think for FII flows to decisively turn positive, we need global bond yields to soften further. What is happening as well is that in addition to US, now we are seeing bond yields, particularly long bond yields, having moved up in most markets. Right? Yes. So since September, October, if you see, while Indian government bond yields are actually softer by about 10-15 basis points, US yields are up about 50 basis points. UK is up about 35 basis points. Germany is up 30 basis points. Japan is up 20 basis points. In
short point, you are saying that you're not very confident that FPI flows are necessarily going to favor us and EMs just yet.
Yes.
Okay. Well, actually, when I was talking about banks, there was another important question I should have asked you. IndusInd Bank, are your worries behind you? It is in the price. And would you say that this is only an IndusInd problem? Similar mistakes will not be in other banks?
Latha, I'll refrain from talking about specific stocks. But I think... more broadly, I will just say that banks in India are very, very closely regulated, right? And I think banks in India, in terms of their balance sheet health, whether in terms of capital levels, in terms of liquidity levels, they are very comfortable by all global standards as well as historic Indian standards. So I think that is something we should be confident about. I will not want to give a view on a particular stock or entity.
No, I know you all are constrained to give stock-specific views. Mine was more yes. a problem-specific question. Yes. It appears that the ALM unit of the bank was a client to the trading unit of the bank. Many banks keep the two separate. And don't allow you to hedge internally. So that's why the worry is, are many banks doing it, and therefore should we see other banks reporting problems? You don't have such worries?
No. And again, I think it's been reported that RBI is now conducting thematic audit across banks on this aspect. So I think we will have those answers in a few days or weeks.
Okay. Well, I asked you about whether FII flows have bottomed out, or rather their outflows have bottomed out. What's your view of Indian equities itself? I mean, we have shown some kind of resilience around that 21,800 or 22,000 mark. Do you think most of our supposed slowdown, our reported slowdown in second quarter and third are now priced in? Are we at a reasonable bottom?
Yeah. So I think if you look at the economy itself, we saw December quarter GDP print was better than the September quarter. Whether we believe the government forecast for the March quarter or not, but certainly March quarter GDP will be better than December quarter as well. So I think the fact that the fiscal spending came back and capex spending from the government stepped up very meaningfully over the last 2 months, the fact that liquidity tap has been opened up, and also importantly, even on the regulatory front, many constraints on specific entities on lending, some of the caps on CD ratios, lending to NBFCs being eased, migration to new LCR norms being delayed. All those are actually positive in terms of really helping a monetary stimulus to the economy. So I think given that, I believe the economy has bottomed out. Of course, I think we are in a much more uncertain global policy environment, and we need to see really the impact of that, particularly on the investment side. So I think there are those headwinds. The outlook on global growth has also moderated over the past 6 months. You would have seen U.S. growth estimates being pulled down by many economists. So I think those challenges do persist. We have to be watchful what happens on tariffs and therefore potentially on margins for some of the companies. But I think the broader headwinds, which were on the fiscal impulse, the credit impulse, the regulatory impulse, all those have turned.
Fair point. So domestic impulses have at least turned the corner, but we are still vulnerable to global impulses. Therefore, at Axis Mutual Fund, what would be the sectors you all would be bullish on?
So it's actually a lot more company specific across sectors. We are still constructive on investment theme, capex theme. We like the automobile sector. We like financial, as we discussed. NBFCs is where we are overweight. Select consumption names because there has been a meaningful correction there as well. And at least we are seeing some signs of pickup in broader consumption. So while urban consumption has slowed over the past couple of months, the broader mass consumption again seems to have kind of found a flow.
Thank you very much, Ashish Gupta, for joining us with your take on all markets, equities, bonds, and of course, in particular, how finance companies are panning out. That's it on this edition of Market Masters and Bazaar. After a break, it will be time for Chartbusters.